mic, bring the facts. Erin in the ring, no turning back. Coby got the numbers clean and clear. Experts in the mortgage space right here. Housing issues, yeah, we dig deep. Every word weigh when the stakes don't sleep. Credit war, you can feel that charge. Every point hit hard, every stance large. Capital Hill, that pressure stay high. Consolidation makes the small ones fight. Servicing trails, every detail counts. Say it plain, then we write it out. No surrender.
Gets it, fires up a three. Shot no good. The chip, it's gone. It's gone. It's gone. With 1.2 remaining. Knicks take the lead.
Unbelievable. How can we not start the show talking about that comeback? Epic comeback last night.
There's no way to not. There's no way to not. One of the most iconic moments in New York sports history. That may turn out to be the most famous shot ever associated with the New York Knicks, if they can close out the series, especially Saturday night, Game 5 in San Antonio. I got off the plane at around 5:30 local time, which is exactly when the game started. I got home, I had it on delay on video. It took me like 3 hours to watch because, once it's on video, you're pausing, and they're down 29 at halftime. And I'm like, all right, I can't. I got to watch this train wreck for whatever it's going to be and figure out, how I explain this to people. When I celebrated after we were up 2-0, now we're tied at 2-2, and I'm looking like, I'm in danger because we're going back to San Antonio. And then, the gods have decreed that this be the New York Knicks year, and everything is breaking for us. And so I'm so excited, riding cloud nine, and especially happy because Garth Graham of Stratmore did nothing but give me shit about the Knicks when I saw him in Maine this week, and nothing made me happier than sending him a "How do you like them apples?" text last night at around 1:00 his time. So go Knicks!
Massive,
so excited,
massive fold.
Unbelievable.
That is the worst coached second half you can possibly ever see. They didn't burn the clock at all. They had Wemby out on the perimeter instead of underneath, grabbing boards. Fox, the veteran point guard, who's supposed to be able to man the floor, he looked completely out of place. Dylan Harper was on the bench, I think the last 6 minutes of the game or something like that.
Yep.
That was terrible coaching. And
the first time coaching the finals with a very young team. And the Knicks just don't quit. There have been 20, and I sent this to you guys this morning. There have been, in the last, I think, 2 years, 5 20-point playoff comebacks by the New York Knicks. The rest of the league has 4. So this is a team that does not quit. The Spurs played from a position of fear, not from a position of strength.
Yep.
You could just tell the urine was running down all of their collective legs. And
yummy, man.
Yeah.
Wow.
Can I say that on the air?
Thirsty. Thank you for that. I appreciate that.
And
Erin, good to see you.
Not be happier.
Good to see you, Erin.
Hello.
Fresh back from your trip to Maine. You and Cobbs, the Cobster, were there sending me all these pictures.
Oh, it was glorious there. It was so nice.
I was very jealous. I got several pictures actually last week and early part of this week, and 2 really stood out to me. There was the one with Bob Brooksmith and Coby. That's a very nice picture. Bob looks like very happy there. He's got a smile on his face, a mile wide. And then, of course, on the left, there's Paul Hindman. Look at this guy. Best body on the beach right there on the left for sure. And he's still doing okay. You know Paul, right? Everybody know Paul here?
Yeah. Paul, look at him in the Bay Area, too. That's the Golden Gate Bridge behind him.
Yeah. He is he's the guy. Tell us, before we get into our agenda, which is robust today, give us a rundown of what you learned in Maine. Why were you there, and what were your takeaways? Erin?
Well, number one, I learned that southern Maine is far inferior to northern Maine with its pink granite. So that is one thing that I learned. And I don't know, Coby, what was your big takeaway?
Oh, the biggest takeaway was there was one night, and you saw in the picture with Bob, he's wearing a lobster bib. They served Maine lobster to everybody, which was wonderful. It was right by the pool and the cliffs, and it was just a gorgeous evening. And I asked Erin the next day, "Did you have any of the lobster?" Because I didn't. I was busy putting together a crew to go out and watch the Knicks game, so I didn't have time to sit down and crack open a lobster. But I asked Erin the next day if she had one, and she said, "No, I would never eat a Maine lobster. I only eat lobster from, where was it?" So,
Australia and South Africa.
Yeah, so we learned that Erin is the most elite lobster snob in the history of lobster. So that was my big takeaway.
Who
Yeah,
knew?
but the NBA did an amazing job. What a great conference. The meetings
Except
were
for the
really
lobster,
great.
in Erin's opinion.
What was the
Except for the
conference?
lobster.
What was the name of it?
Chairman's?
Okay. That's
Yes.
normally, and isn't that held down south normally?
No, so the person who's the chairman actually gets to pick the location. And Christine, while Maine or the Northeast didn't really have a particular connection for her, she really wanted to go somewhere that we had never been before, and somewhere on the East Coast, because that's
I
where
love
she's
that.
from.
I love that. More conferences should do that.
Yeah, she did such a great job picking location. NBA did a wonderful job putting the whole thing together. It was definitely one of the best I've been to in a long time.
Did she have an aphorism when she was there or no?
I
What?
knew that one was going to get pulled back out.
Well, I'm just curious. And if anyone's wondering what that
Something
means,
that
by
is
the
an
way,
aphorism to something that is a serious.
I don't know what happened here. Hold on a second.
You're not good at playing on the
Is an
first time.
Just stop it. Stop.
Something
It's
that
not young
is an
folks.
aphorism to something that is a serious financial
Ooh.
decision.
Coby
That
with the big words again.
yeah,
Aphorism.
dropping aphorism. Yeah, some sort of saying or something that we say enough that we think it's true, even though it's just a saying. And that's what Marry the
Now
House,
spell
Date
it.
the Rate is. APHORISM.
Well done. 6th grade spelling bee champion, Coby Hakalir. Well done. All right, let's jump into it right now. Hey, we had a big merger several days ago between APM and Synergy One. We're going to start it right there. What the kind of what and what it means to the industry. I had Steve Majerus on my program one-on-one about a year ago, June 2nd, 2000. Is someone doing electric shaving here? What is that noise?
That's unfortunately outside my house right now.
Are you sure, Coby? Put your hands up, please.
It's not me.
I don't know if it was trim time. Okay, good. Very glad to know that.
It's never a bad time for personal hygiene, even
You know
during
what?
no surrender.
Amen.
Listen, when you got to do it, you got to do it.
Of course, yeah. Anyway, all right. I digress. Of course.
What's funny is that I got home last night from my trip and I noticed that my gardener had not mowed the lawn, and so I texted him at like 5 this morning. I'm like, "Hey, you usually come on Wednesdays. What's up?" And he's like, "Oh, I'm so sorry. We'll be there right away," which means exactly when the show started. So that was my fault. I put that in motion. But
you should bring your. I want to know what it's like to be your lawnmower guy. If there's a way to bring your lawnmower guy onto the show, that would be something for the ages. So just think about that as we continue here. All right. So APM and Synergy One. I had Steve Majerus on my program one-on-one, which airs Monday at 1 on LinkedIn. This was about a year ago, and he gave us a glimpse. I asked him about the future and how he was thinking about the future, and this was his answer. And then we'll get into the merger.
A very enthusiastic but measured approach to growth. It seems like all roads kind of in discussions still lead to what the rate environment is going to allow and therefore dictate. Loans are hard to come by. The origination market is not robust. And so I think us refining and retooling our value prop that we helping loan officers become and stay relevant for achieving greater and greater market share is really going to be the focus of our company.
Yeah, and I think when you think about this, it's really anastomosis is what this is, of course, which is two powerful pipelines now flowing as one network. Anastomosis is probably what you were going to use that word, Coby. If I didn't, I'm sure you know it well.
It's on the tip of my tongue.
Do you want to spell it? You want to try and spell it? Anastomosis.
I don't want to show off.
You were spelling beach. You should show off, please. Anastomosis. Go ahead, Coby.
Yeah, ANASTO.
Yeah. Anastomosis.
ANASTOMOSIS.
Wow.
Is that right?
Holy
Talented.
shit, dude.
Talented.
Holy shit. You crushed it. Wait, look, guys at your door. Bring them in. Look, the guys at your door. Coby, get up. Come on. I'm serious.
Oh my
He's
God,
walking.
he is at my door.
He's at your door. Come on. Get up.
Oh,
You gotta get up, Coby.
He actually just knocked on my door. Do you want me to bring him
Open
in?
the door. Yeah, bring him in. Let's go. Come on.
Do it.
This is wild.
I only know
Ask and you shall
anastomosis from Grey's Anatomy, by the way.
Ask and you shall receive. What's going on here?
The universe is working for you.
Have him sit down at the table.
Hey.
Hey, how are you?
Can you come on your show?
Hi, how are you? Have a seat, sir.
Nice to meet you.
Come on in. Come on in.
So he's actually not my he's not the gardener. He's here for a different thing in the house.
He's got something for everybody, man.
We're having
Incredible.
a wild morning here. I'm sorry about that.
Oh.
All right. Anyway, so let's talk about this acquisition. First of all, take a look at the heat map, courtesy of Redder, and we can see what APM, which has done roughly 11 billion in the last 12 months. That they are in green, and you've got Synergy One in purple. And this is a really cool tool that Redder created about a year ago. Steve Winans, the founder, co-founder of Redder, came up with this idea so that when companies are looking at merging, or is Coby talking to himself? What's going on here? That's very strange. When
a serious like
ODHD, ODHD, what is that? Like
it's offensive.
I lost my meds. I can't find them anywhere.
Stay on target.
I mean, the guy's distracting me. He's got people at the door. He's got trimmers going off. He's got a painter in there. What do you want me to do? He's muting and talking like it's my fault.
As long as his masseuse doesn't show up, we'll be fine.
Yeah, I'm so sorry. This is like the worst.
That's all right. Should we start over? Oh no, we're live. We can't.
This is a serious program, Coby.
Anastomosis. Let's go.
All right. So this is it looks like a pretty good. I mean, obviously, you're never going to be when you're talking 15 billion in volume, 4 at Synergy One, 12 at APM, or 11 at APM. You're never going to be perfect in terms of where you are vacant and where you are doing a lot of business. But this really looks to make a lot of sense. And Steve Majerus, someone that I've gotten to know really well over the years, I have to give him a lot of credit for being patient, because it's not a big secret that Synergy One has flirted with other partners before in the past. And it was never about desperation. They've always been doing well, but I think Steve has got this abundance mindset where he's always open to the idea that all of us is better than one of us, or, the sum of us, whatever the saying is. And in this role, he gets to be president. And I know that he wanted to hang on and be a big part of whatever was next. And so I really tip my cap to him. And now they're a $15 billion juggernaut. Erin, what do you think?
Listen, I mean, by all accounts, this is a great fit for both companies. I think I read in an article that there might be some overlap with loan officers that they're not too happy about it. But in the end, this just seems like a really good fit. I mean, we talked earlier this week. My brain just always goes towards consolidation and what that means. This industry has been put under a lot of pressure in a lot of ways in the last few years, and it's making consolidation make sense, make it necessary. We've got to lower our cost to originate, our cost to produce as an industry. I'm just constantly looking to make sure that, we're not consolidating to the point where consumers are losing options, where there's a systemic risk to the system, right? Because we are so consolidated. And so I love the small IMB. I think I love working for one. I always have. And so I just hope that other smaller lending institutions work really, really hard on staying competitive, lowering that cost to originate so that we don't have to be consolidated if we don't want to.
Yeah, 2 mid-size IMBs here that have now combined for some serious scale. I think this puts them both in the top 10. And look, to your point, Steve was definitely methodical about this, and it was no secret in the industry that he was looking to do something, to the point where there were a lot of people recruiting his loan officers, saying that the reason he was doing this was because of financial instability. If you recall, about a year or so ago, Steve came out and put a video out saying, we're financially sound. And to those of you who are trying to recruit my loan officers saying we're not, I'm going to rebut that. And he did it publicly, which was a great move. And you don't see a lot of that happening, where somebody comes out and says, hey, just leave my people alone, because we're in good shape, to the extent that has impact. But the fact that he did it, I thought was a great move. I'm excited to see what'll happen with these two companies. Yes, there's a lot of overlap in production, but it's not like there's overlap to where now it's 120% of the market and somebody's going to lose. You can have, 2 loan officers from 2 companies now coming together that both have market presence with, 2 different realtors. And this just gives them economies of scale. I think we're going to see a lot more of this in the future, meaning in the next 12 to 18 months, of mid-sized companies coming together to try to achieve that scale, because we know margins are thinning, and this is the way they're going to look to build and to be profitable. So I think more to come.
Erin, you said something interesting when we were looking at this topic, and that was that, you kind of peeled it back a little bit now, but I want you to go a little deeper on your concern that, longer term, as we get more of these consolidation moves, that the consumer might not have enough choices. I mean, what is that threshold by which you'd be concerned that they would cross over there?
Yeah, I think just if you get to the point where right now consolidation is actually, I think, helping consumers, because when you have companies come together, create economies, lower their cost to produce, that actually helps the consumer. And so I think once that stops happening, once you stop being able to combine lower costs, right, where you only have a few players in the market to where they're not competing for the customer's business as much, right? Where you just have you have 4 choices. Well, they're not going to be competing for business the same as if you're competing with 100 other lenders. And that's the concern that I have, is wanting to maintain a robust competitive environment for consumers. When Rohit Chopra was still the director of the CFPB, I met with him twice. I had the opportunity to, with the Mortgage Collaborative, and he both times expressed his sincere concern about industry consolidation as well. And so, I don't know what that looks like for future CFPBs, but it's something that's on the Fed's radar as well. And so, as long as we can continue to provide a better and cheaper experience for consumers, I think it's good. But the second that changes, I don't know what that number is, but the second that changes, then that's where I have a problem with it. And one of the things I enjoy working at the mid-sized IMBs is that as a decision maker, I'm close to the ground. I'm close to the field where my loan officers are living every single day. I spend time out in the field. I talk to them regularly. I'm not so far removed from my loan officers as the COO that I don't know what they're experiencing. And I think that it's important for the decision makers at a company to be very close to the field. And the bigger you get, the more layers you have, the more you lose that.
Yeah, see, I look at it more from the standpoint of, are there a lot of banks out there? Are there a lot of credit unions? Are there a lot of people in the wholesale broker lending channels? So there's still a lot of options, right? And so, there's online lenders, there's self-generated community lenders. So I don't know. I think that when we get to that point where a few are doing the most, then that's when you'll see an uprising and more people will enter the market. So I'm not that concerned, but certainly a legitimate concern. And these things are difficult. These are not easy things. I mean, you take however many employees that Synergy One has. I'm guessing, we do 8-9 billion. They do half of our volume. We have 1,200 employees. So let's just call it 500 employees for them, something like that. Like it's never easy to meld these companies together. But I feel like if anybody can do it, Steve Majerus can. To your point, Coby, people tried to pick them apart, and they lost some people, but for the most part, they had a lot of loyalty there. And I think it starts with him and Erin Nemec and the other great people in leadership there. Any last comments on the move?
I mean, it just also helps to slim out employment in the field, right? I mean, there's always going to be attrition when you look at consolidation like this. And so, what does it also mean for employment?
Yeah, it's a great question. Great question for sure. All right, now we are going to go pivot into marry the house, date the rate. This is
sounds like a game show.
This is a really interesting topic, especially in light of the fact that slogan really became famous in around 2022 when rates started to shoot up. They were ascending mightily, right, off the lows and heading to 7-8% in that range. And now comes some statistics, which led me to make a post recently that marry the house, date the rate has not aged too well. And this stat just came out. Delinquencies and foreclosures are creeping higher, concentrated among recent FHA buyers. Foreclosure starts rose to roughly 37,000, with filings up 26% year over year. And the strain is heaviest among borrowers who purchased from 2022 and up. And we're talking about, marry the house, date the rate. And I think we've all seen some of that stuff. But here's one example, and there's thousands of them online, thousands of people like this that were pushing this idea.
Marry the home, date.
Don't do this to me again. I swear. All right, hang on.
Every time.
Marry the home, date the rate. What does that mean? Commit yourself to buying a home. Don't be a renter that's on the sidelines. Buy the home that you love, that you want to raise your kids in, and then date the rate. What does that mean? That means that you're just dating casually, that you're not committed to a 30-year relationship with them. That if at any point in time, if the rates drop, you're going to drop that rate that you currently have and get the new rate. See, your payment is fixed for now, but it could be lowered if the rates go lower, which I think ultimately they will. So
See, it's that last part, which I think ultimately they will. That guy's an expert. I'm not calling him out, in particular, but many people were propagating this idea that rates were definitely going to go down and go down very soon. So I had this post that I had on LinkedIn saying that it just essentially hasn't aged well, and the data coming out is further proof, further evidence. And I got a lot of pushback. Kevin Peranio, my good friend KP, said, no, you're wrong. Barry Habib said it's actually worked out great. Julian Hebron with something that really caught me off guard and taken aback by this, and that is, as you know, consumers have zero obligation on a prepaid penalty loan to stick with current lender, and who'd rather not get hit with an EPO if rates drop, which they do in these tough years. Blah 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 blah. An EPO should never stand in the way of a consumer taking advantage of that. Shouldn't current lender either eat the EPO or make peace with losing the client? Coby, I know you have a lot to say about this.
Yeah. So the marry the house, date the rate, there's a caveat to that, which is if we're telling consumers marry the house, date the rate, but make sure that whatever the payment is now, you're able to afford if you never get a lower rate. And that also be cognizant that your insurance and taxes are probably going to go up because here's what they've done the last 5 years. If we're painting the entire picture, and part of that picture is that you might have a chance to save money, you might, with a capital M, that's one thing. The other caveat to this, and it ties into the EPO conversation, is if we're putting loan officers out there, let's say this is a company policy to say, hey, go out there and tell your customers that it's a good time to buy because they're going to be able to refinance. And then the loan officers go out and do that. And the customer then winds up 3 months later, 4 months later, finding a dip in the rates and refinances. And now we're clawing back that compensation from the loan officer. Well, I think there's some misaligned values and missions there. So, I'm not sure that giving any advice to consumers making the biggest purchase of their life that's based on something that's catchy is what we should be doing in general. And I also think there's some misalignment between what we're encouraging people to do and what we actually want them to do. Because if we're telling people marry the house, date the rate, but only if it dips after the first 6 months so you can make all of your payments and the servicer doesn't, put a clawback in there for some of the commission, then we're not really giving them the full picture of what's going on.
Yeah, I mean, I never liked the expression. I thought it was dumb anyway. I mean, what we do is serious business, and so to try to sell based on a slogan just seemed stupid. But I think in terms of the EPO, at the end of the day, EPOs exist and they are a thing, right? And so where there's a clawback, it's because the LO comp agreement states my commission is prepaid and it's not fully earned until after 6 payments have made or whatever, giving the LO or the lender the right for EPO. And so, if you want to look at that and say, well, we shouldn't be clawing back EPOs, then, that's I think is a much different case, because then you're asking, the lender to take on all this additional financial risk. And so does that change what they're willing to pay in compensation for it?
Yeah. And Barry pointed out that there have been, at least I think he estimated 10 or so opportunities where people, 10 specific opportunities to have refinanced your clients over the past 3 years to much lower rates. I mean, I hate to disagree with Barry. The guy is just a living legend. I love him. I worship the ground he walks on, actually, for the most part. But I don't understand here what Barry's saying, that the facts do not agree with my statement. And, he's defending marry the house, date the rate as being, something that was not a bad thing, that wasn't bad for the industry. I mean, at the end of the day, thousands of consumers got their houses based on the manipulative slogan, And believe me, there were a lot of people that said to their loan officers, I'm just not sure what to do. I just don't know. I see the trajectory of rates. I can't, I can only afford this payment for a couple of years in my savings. And there are plenty of loan officers that said, don't worry about it. Like, here's this chart, here's that chart. Let me forecast for you. You'll be able to refinance. And by the way, here's what it looks like, 1% lower. Imagine that payment, right?
Yeah.
Very irresponsible. I think what I really want to, what I want to say is, how can we learn from this? How can we walk away and recognize it next time so that as it's happening, we step forward and say, you know what? No, don't do that. Because I don't feel like a lot of people did that. I feel like a lot of desperation sat in and people were all about it.
Yeah, I mean, I think to Coby's point earlier, we have to make sure that we're having actual conversations with consumers about what they can afford and what the reality of it is. And if you have the opportunity to refinance down the road, then that's fantastic. You have equity and a lower LTV or a better rate, whatever, right? But what we do is serious, and it's a big investment for people. And if they don't do it right, there are massive consequences to their own personal credit, their own personal financial situation. And so that's what we need to focus on, is that we're helping people with a major decision, and we need to treat it that way.
Are you proposing, Greg, that this rose to the level of predatory? Because you put up that graphic of the 37,000, and then you talked about how many people were impacted and by loan officers being manipulative. So are you saying this rose to the level of predatory activity on the part of loan officers?
I mean, I'm not an attorney, but consumers were misled. So if you call that predatory lending, sure, it happened.
Well, predatory in terms of manipulation, in terms of putting people in a position that they shouldn't have been in, or that they otherwise wouldn't have been in.
I mean, you want to get a class action together. You know how many consumers would be willing to say that they were convinced, even had their arms twisted to go in on a mortgage based on a promise that was made by an expert. I mean, at the end of the day, on the other end of the communication and the loan is a loan officer that professes to be an expert that knows the trends, right? And the other thing is, you want to comment on it before I saw you roll your eyes. That's normally meaning you have something to say. I'm getting to know you pretty well, Coby.
I didn't roll my eyes.
By the way, yes, you did. By the way,
that's me thinking.
Yeah, who's next? Is it UPS, FedEx, Domino's? Who's knocking next?
This is what happens when you're on the road all week, and then all of a sudden you come home and like you've had, and I told these people not to show up during this time, so of course they're all showing up exactly when I told them not to.
You need a sign. We need to contribute, Erin.
I need to establish a perimeter around the house like they did around Madison Square Garden to keep the fans away. I need 60 feet of privacy.
Just no yellow tape. Otherwise, the TV crews will show up, okay?
That's true.
We don't want that.
Yeah.
We do not.
We don't want any yellow tape. All right. We have a lot more to get to here. The CFPB turning lenders into ICE. This is a really interesting topic that you unpacked earlier this week, Coby. CFPB just issued new guidance on June 8th, telling lenders they can and sometimes must consider a borrower's immigration status when judging their ability to repay credit cards and mortgages under Regulation Z. What in the hell is going on here?
Yeah, I mean, just more of the lending industry being used as an extension of a political agenda. And we all know what that political agenda is right now, which is a heavy emphasis on ICE activity and monitoring those that are in this country that some people wish weren't. We've seen unprecedented levels of ICE and deportation activity, and some that is really cause for concern. And now it seems like the lending industry is being co-opted into that. And this directive doesn't call out ITIN loans specifically, saying you should not make ITIN loans, but it does say this is where you'll find a lot of that. A lot of those issues, and this then moved from a Reg B, which does allow you to consider some of the borrower's ability, to the ATR, which kind of shifts the focus a little bit and makes it even more onerous for lenders. And then it also in this directive threw out the ECOA, which is that as a reminder, you can't discriminate based on someone's nationality or origin. So which one is it? It's the noose and the rope all in one, as I put in my LinkedIn post. And the net result are two things. One, lenders, if they're going to turn down a loan because they believe that the borrower may lose their visa or be deported, they're going to have to record that. So now you've got streams and streams of data across the country by various lenders of people that they've made adverse decisions on, thinking, well, they'll probably get deported. And what a great list that would be for ICE. Number one. Number two, guess what happens when the regulations are murky? And Ballard Spahr, the big CFPB law firm, came out and said this is unenforceable. No one understands how to interpret this. So the natural endpoint of this is that lenders are going to just get out of the ITIN business. Why bother if it's such a minefield? And the administration clearly doesn't want these kind of activities going on. So at best, it's the program going away. At worst, it's trying to put some sort of police action into what the lenders are doing as far as policing our borrowers and creating data around it. It's got so many negative implications as far as I'm concerned. And I think we should all be very concerned about it. The NBA, I know, I had a chance to talk to some of the NBA policy people this week in Maine. It's definitely on their radar and high up on their radar. What they can do about it, they're not sure at this point, but it should be concerning for every one of us.
Well,
Erin, how concerned should lenders be?
I mean, I think we should definitely be concerned, right? I mean, this is one of the few areas that Trump is winning on in public opinion. It follows on the heels of FHA not allowing permanent resident aliens, and then using that policy change to say that they were preventing illegal or undocumented immigrants from obtaining loans when that wasn't happening in the first place. And so I think one of the concerns that I have here is there going to be a pendulum swing to where it's going to affect more than just ITIN loans, because it is murky. It does create grayness. And when you have we have a risk-based business and compliance, people see that, right? Are they going to restrict even further to people who are here truly legally? And is this really going to put these people in and make them unlendable when they should be? And so I am very concerned about the pendulum swinging and what it's going to have outside of just even the ITIN market.
Well, this is going to increase compliance burdens too on mortgage companies.
Correct.
Do we all have to become immigration experts now?
I mean,
yeah.
Try doing a loan right now anyway with somebody who has a C1 visa and the EAD is expired, right? I mean, we already have to do some of that, just to document their legal status. Now, we do have a new CFPB director that was just nominated yesterday, and I hear really great things so far from my people in DC about him. They're pretty excited. And so, maybe that'll be an adult in the room that can have a conversation about this.
Coby, anything you want to touch on here? I know that you drove this slide home.
Yeah, I think I touched on all the points in my comments, but the real exposure being private TILA lawsuits, secondary market buyback risk, and the likely result, overlays pricing or pullback in ITIN lending. And by the way, ITIN lending is some of the best performing loans because the down payments are larger and there's skin in the game. And this is just another example of the administration talking out of both sides of its mouth, where it's trying to encourage more broader products in terms of lending, in terms of more access to the market, but at the same time, quietly putting restrictions in place to limit it.
All right, we're going to flip now over to better.com and Coinbase, because they are in business together. And what we're looking at right now, or scrolling to learn more about this product they have, which is partially backed by crypto that you pledge that you can't liquidate as long as it's tied up into this mortgage. According to my good friend Coby Hakalir, the exposure is on Better. I think Fannie, is it Fannie that does the first loan, or Freddie? I think it's Fannie. It's Fannie, yeah. But here are some of the risks, and then we'll dive into this. What happens if my Bitcoin goes down? Bitcoin's, you'll never be asked to add more collateral, but if you miss a mortgage payment, you have 30 days to bring your account current. If you remain delinquent for 60 days, Better Mortgage may liquidate your pledged crypto. I'm concerned about this. I don't like it at all. I mean, I am a crypto holder. I don't own a ton, believe me, but I feel like you look at the demographic of who owns crypto. It's mostly Gen Z and millennials, and a lot of them are first-time home buyers. Is this the entree we want them to have by risking an asset we don't have enough data on to get this mortgage? Coby, your opinion?
Sounds to me like Better's taking most of the risk here. There's a 250% risk weighting. So $100,000 down payment requires a $250,000 pledge, which can never be margin called unless you miss 2 payments on the crypto loan, not on the underlying Fannie loan. That has normal Fannie and default and foreclosure procedures, as it indicated in what you just showed. But Better is taking all the risk here.
Really? What about the consumer? What about the consumer? They're not taking the risk. The 27-year-old that's always dreamed about you're shaking your head. How
No.
can you say that they're not taking any risk here?
Because what are they risking?
They're risking the ability to pivot in and out of their money for one, right? It's a 2.5 to 1 ratio, whatever it is, 250 to put up 100 grand. My understanding is they can't get out of that.
That's not a risk.
How's it not a risk? What if they start to see the market go down? They could get out of that asset and into something safer, perhaps.
They have that option. They have that option to pay it off. They're making a financial decision, not taking a risk. Better is taking the risk because they can't margin call. If that underlying asset drops 80%, as long as that customer keeps making the payment on it, then they can't foreclose on it. And they're left holding the bag. And if it drops to zero, well, guess what? The customer still has to make the payment, but that would have been the same thing that they would have been doing if they were saving up for the down payment. But they've lost their underlying asset. But they can't
flip out of that. They can't flip out of that easily, as you're saying. So if you grab 100 grand and you pledge 250 of Bitcoin, you're making it like a week later they can just call and be like, oh, we're just gonna take that money. I mean, I think that Better becomes the custodian of that money, is my understanding. Yeah.
They do.
So how is it that it's so easy? If something, and the other thing is, are we sending the right message to younger people who have never bought a home that they should be taking this kind of a risk? Erin, why are you smiling at me?
Because the data.
Do I have food on my face?
You do, but you usually do. So that's fine.
Thank you very much.
Right. Okay. So that video you just played is where you can go to Better's website and enter to join the wait list for to join the pilot. And look, this is the same disclaimer language that we talked about a few weeks ago. All this is for pardon the pun, it's a better mousetrap for a lead funnel. That's all this is. If you look at the data, what is it? 74% of Bitcoin owners only own 0.01 Bitcoin or less. Only 2.3% own one full Bitcoin or more. And Better themselves in their marketing materials, this is only a $250 million pilot or whatever, right? And so one, it's a very small amount. And two, the audience with which can do anything with this is so small. This is just a new way to get leads in the top of the funnel that is creative and hasn't been done. And I honestly, I don't have a problem with somebody putting out a new innovative product, right? I mean, this is a Fannie loan. So at the end of the day, the taxpayers do hold risk on this. And so, if there are losses through foreclosure, but you've got down payment with Bitcoin. And Better is taking that first risk, right? And so that's where the only reason I would have problem is if the taxpayers were going to be on the hook for this. Better's taking a big stake in it. And it's a very, very small number of people. And it's mostly just for a lead funnel.
I mean, I appreciate that perspective. That makes me think about it in a different way, that they're able to generate leads. That is very hard to do at the top of the funnel. Better's obviously very good at it. Let me give you some statistics from Better's own wait list. 76% are Coinbase users. 37% hold 500,000 or more in crypto. 63% plan to buy a home within 6 months.
So let me ask you something. If you're looking at who's on that wait list, are you that worried that these people are not financially sophisticated enough to make a decision like this, to pledge some of their assets to buy a home? Or is it the extension of all of the calls we've had in our industry to be more creative, more innovative, open up lending to more people? Yet every time somebody tries to do that, we get pushback saying, is this going to be dangerous for our consumers? Can they really handle this? Are they aware enough to do it? The truth is, it's our job to create these products, be innovative, and then also educate consumers. And if we do that, then we've got a healthy and balanced market. If we shut the door every time we see something new come into the market because we're afraid that somebody may misunderstand it or may misinterpret it and get themselves in trouble, that's going to be very, very pernicious for our industry over the next 10 years.
Well, and the Federal Reserve did a study, so it's not some radical group. It's the Federal Reserve did a study showing that Bitcoin investors are significantly more financially literate than non-Bitcoin owners. So
yeah, I like to see who commissioned that study. I want to know who did that study.
The Federal Reserve.
Yeah,
I'll
like
send
to see it. I want to see it.
You.
Yeah, I'm going to peel that one back.
All right.
I'm peeling back that onion. Keep going.
That's it. That's it, right? So you're not dealing with some podunk backwoods, youngsters who don't know what they're doing. You're talking about a cohort that is financially literate and that is set up to understand the transaction better than others.
Bitcoin's at 63,000 right now. Do you know how far off its high it is?
Half.
50%.
Yeah, it was at $126,000.
Yeah.
So that shows the volatility of this asset. What tells you that we're in a period of time with rates high, with according to you, Coby, a surplus problem, right? In terms of inventory is concerned, and we've got property values going down at the same time, and we have Bitcoin that has been halved. So what tells you this is the right time for this experiment, regardless of how big? Because I didn't get to answer your question, because your question was how concerned are you about these people that have 500,000? That's really not what I'm saying. It's more of the perception thing. It's like the marry the house, date the rate. Enough people see this, hear this, get excited, get caught up into that funnel and think, oh my goodness, I can use Bitcoin for this, that, and the other thing. I think it can have residual impacts that go beyond a mortgage. I think it can get into the psyche and but encourage the people that hold it, the younger people who now Erin tells me, according to the Federal Reserve, are more literate than the average human. That's amazing. I do want to read that. But that they'll know better. To me, it's nah. I'm not all about it. Any other closing statements or any more questions?
I think you're painting with the widest possible brush, the real estate market. Values are not going down in all markets. There are not supply issues in all markets. There are borrowers that are more sophisticated than others when it comes to first timers, and there are products that work for some and not for all. And I think we have to take that all of the above approach when we're trying to solve the problems we have, because number one, they're very unique in all 3,000 counties that we have in the United States, and the problems have to be solved in different ways for different folks, and we have to figure out what we can do to reach the broadest possible amount of people with the broadest amount of solutions. That's it.
And the other thing is, the other reason this is bullshit, on a more global level, is what does this do for the first-time home buyer? What does this do for the struggling person that's sitting with a 622 FICO that can't get into a home? What does that do? We're talking about the more affluent people that, according to the Federal Reserve, know what they're doing. You're looking at this going, oh, 500,000 or more. How worried are you about this, people? This is just another thing that takes the eye off the ball we should be focusing on. And that is figuring out ways to get people into houses that are on the outside looking in, sitting at a 40-year affordability woe. Okay.
But there are solutions, right? The Urban Institute wants you to do 100% FHA loan. So people are being creative with solutions for the people that have Bitcoin and don't have Bitcoin, and maybe and the entire reason for that 100% FHA loan is precisely because they feel that market segment is not financially sophisticated, and the DPA barriers and the gifts are preventing those 14 million extra entrants into the market. So there are people examining different segments of the market. I don't agree with what the Urban Institute is doing. I think that's a slippery slope there, but I think that they are addressing that segment of the market that you think is forgotten.
Well, and these people that are pledging their Bitcoin, otherwise they would be selling and liquidating it to purchase a home, right? And so it's allowing them to retain it.
The loophole is the cap gains. You don't have to. So for people that got it at 10,000 that are sitting at 60 now, they can just roll it into the purchase of the home and lock that up. So that is the other side of it. Yes, they could liquidate, and honestly, they should. I feel like they should liquidate it. I mean, who am I to say that they should? It's just an opinion, okay? But why not do it the traditional sense? If you're comfortable, putting that money in, put it all the way in.
Keep doing it the way we've always done it.
Don't half step into a gimmick is what I'm saying. And I'm not suggesting we keep doing it the way we've done it. I'm not that old and crusty. I am wearing fresh underwear. Okay. Just so you know.
What's your definition of fresh, Greg?
Only worn 3 days in a row. Okay. Major improvement for me.
Fresh for this week.
Oh my goodness.
He's wearing his June underwear.
Hey, how about we sunset or give some kind of a period of time where we waive MIP for first-time homebuyers or something like that. Great. I don't know. I know I'm stretching into an area, and this is not Better's fault, but to me, this is there's a lot of threads to this, and I think that the timing's not good, the perception's not good, and it's sending the wrong message, and we should continue to have our eye on on the biggest problem we have in mortgage right now, and that's affordability. And I know you would argue that this does that, but again, these are well-to-do people that are great with their money. So
well, which one is it?
Well, this isn't a government program.
Huh?
It's not a government program,
I
though,
understand
right?
that. I get it. I understand. No, I totally get that.
I
the
applaud better for
support- yeah, the government. The government supports that. I know you applaud better.
Yeah, I mean they're taking risk here, but they're coming. This was a Bill Pulte, the DNI. This was him saying we should have crypto-backed mortgages. This is an offshoot of that. And so I think what Better's doing is, yes, I think they're taking a lot of risk here, but I applaud them for putting new and innovative markets and getting interest from people that have an interest in housing that feel like maybe they don't have the ability to get into the market. Well, here's a way in.
And what's behind that push, Pulte's push, you think? Could it have anything to do with the fact that the Trumps are knee deep in crypto, even have their own coin, or is there nothing to do with that? Is he just being really innovative, Bill Pulte?
Well, you tell me. I mean, you like the guy. I mean,
I like him, but don't be confused. Don't conflate here, Coby.
Do I feel like there's a monetary interest that's at play in this agenda? Sure, but this one happens to align with opening up housing for more people, and sometimes both things can be true.
Okay, let's jump into another topic here. This is our last but not least. We're going to talk about this latest jobs report. Erin, I know you have a lot to say about this. The numbers were pretty audacious, but misleading, you believe?
I think so. And the reason I think this is important is because Cleveland Fed Pres Beth Hammack came out after the JOLTS report last week and basically said that based on this data, she thinks the job market is in balance. She thinks that it gives further evidence for a rate hike. Now, inflation is probably going to drive that decision no matter what. But I think if we're going to have our policymakers make decisions based on these data, then we need to really dig into it. So the beat, the estimate was 80,000. It came in at 170,000. So pretty big beat, right, by 92,000. But looking at the numbers, 70,000 of those jobs were in health and hospitality services. I think 48,000 alone were strictly in restaurants and bars. And those numbers are attributed to the World Cup. If you look at the job listings in the 11 World Cup cities, they were up 30% over the prior month's average. And all other cities were down by 23% on average. So, you had this huge beat. Almost the entirety of the beat was taken up by these jobs numbers in hospitality that are driven by the World Cup, which is temporary, which is part-time in some cases, right? So I don't think that the jobs picture is what we were making it out to be based on the JOLTS numbers. And I think next month, I'm looking forward to seeing next month what the numbers look like in comparison. What is the revision, if any, going to look like? But I think it does make sense. You have all of these additional openings where you've got the World Cup coming, right? And then if you look on the flip side, we just had the highest number of cuts announced since the pandemic. WARN numbers, or the advance notice for layoffs, indicate 208,000 jobs are going to be cut through layoffs. And then that chart that I had up there showed consumer sentiment. So it graphed. This is Danielle DiMartino, both QI Research. Love them. If you don't know Danielle, follow her. She's great. But she basically looks at alternative data sources and compares them to what the official numbers are telling us. And the number that she was looking at was, what are the expectations of workers if they were to lose their job, of how long it would take them to find a new job? And those numbers are plummeting. So you're seeing higher actual job cuts. You're seeing high numbers of layoffs being announced. You have consumer worker sentiment being down. And so I don't think that the jobs picture is as robust as the JOLTS headline led us to believe last week. And so I just hope that if our Federal Reserve is using this data to make decisions, they are digging deeper into it.
And of course, Coby, the BLS. I mean, when's the last time that number didn't get adjusted down? So I mean, more often than not, it seems like things are rosier than they really are. That's a whole nother conversation we should have. That should probably go the way of the dot plot, which is going to be being laid to rest here any day now by Kevin Warsh. What are your thoughts on the jobs report, Coby? Anything stand out to you?
Yeah, I mean, the World Cup hiring giveth a headline, and the Fed taketh away the rate cut. So I think we're seeing wage growth a little bit higher than what the Fed likes to see. Which we're that's going to embolden the hawks. And I think that the other number in there that is interesting to me is 22,000 jobs lost in the commercial banking and insurance sector. So we're starting to see the financial sector bleed. And I think we're down 107,000 jobs from May of 2025 in that same financial sector, which is not mortgage. Obviously, it covers a wide swath. But, I'm curious because we had the AI discussion last week. I'm curious to know how much of that is because of AI and how much of that is just because, we know the commercial sector is hurting. We know the insurance world is struggling to make profit. So I think those are good things to keep an eye on as well, is where we're actually losing the jobs, not necessarily where we're gaining them.
There's
I
also
think sorry.
No, please.
Well, I think in the job cuts data, which by the way, were primarily are heavy in the tech sector and the pharma sector. So these high paying jobs, which all the job ads were in restaurants and bars, not high skilled, high wage jobs. AI automation was the number one reason listed for those job cuts in those higher skilled sectors.
Yeah, I don't necessarily believe that when I see it though. I think we tend to blame AI for job loss anytime we're not running the company right. So it's an easy thing to say, because it sounds like you're being innovative and tech forward.
So what just happened to your microphone? You just doubled in your amplification there.
Oh, I don't know.
You have an electrician working at the house, or
I'm having an
electrician among the workforce there. What's going on?
There's at least a couple of people under my desk right now, so I don't know what's happening.
Whoa!
Oh, geez. Wow.
It's gonna be that kind of party.
It's a weird day here, man. It's a weird day here.
You're not moving much. I'm not surprised. There's another statistic in here that stands out to me. New college grads, unemployment for them hit 5.6%.
Mm-hmm. Yeah, they're having a real tough go of it right now.
What does the future look like for our kids? I know that's not necessarily mortgage related, but it's something to really start to think about.
Yeah, I mean, we've got a number of layers to peel back there. Chief among those is the financial and university industrial complex, which encourages kids to take classes in majors that have no value past school, but saddles them with $300,000 worth of debt. And it's encouraging more kids to get useless degrees because they give them the loans to do it. So this is a massive problem that has to be solved at a much more fundamental level than just creating more jobs, because there's no way to create more jobs for Egyptologists and basket weavers. We have to actually have kids study things in school that matter. And the reality is that for most kids in the United States, it may not even make sense to go to college anymore. It may make sense to learn a trade or go to a vocational school. But we've pushed kids into this massive debt with the promise of a job, and we've done a horrible job of it. Horrible.
Yeah. Well, and it's not even the underwater basket weavers that are suffering this, right? It's you're seeing people that are coming out who went to school for things like coding, even for attorneys, because AI is taking the role of what first year attorneys do, right? And coding is being done now with AI. And so, even ones that probably went into it thinking that they had a viable and valuable degree are dealing with this as well.
Covered a lot of ground today.
We did. We got through so much so quickly.
We found out
so many people in my house. So many people in my house.
How many people exactly are in your house, Coby?
There's right now there's nobody, thankfully, that I know about.
Just the people under your desk.
Yeah,
just the people working under my desk trying to fix the microphone.
Hardest job they've had all day.
I will say how lovely of a time it was to spend with Erin in Maine.
Maine is I was very jealous, man.
Maine is lovely this time of year, and it's even more lovely with the likes of Erin D.
And Brian View, our good friend Brian View, was there too.
Our good friend Brian View. I got to play pickleball with Brian, and we both managed to emerge unscathed and unhurt, although both of us probably hobbling a little bit later this week. But yeah, it was so much fun. So many great people. And we learned a lot. There were some really informative closed door sessions that we got to attend that, I thought were pretty important for the industry and the conversations we're having.
I agree. I had an absolute blast. The Knicks game was so much fun. And, obviously it's the closed door meetings are good, but there was a lot of open time for networking, which helped me build a lot of relationships that I've been wanting to for a while. So it was great. And then next week, looking forward, I'm headed to Ohio for Rich Swerbinsky and his Ohio MBA event. So that should be a good one too. Maybe not the same views, but be good anyway.
Any talk about no surrender when you were in Maine? Anybody come up to you?
Oh yeah.
Yeah.
Yeah, we
Absolutely.
have people coming up actually giving recommendations for what we should do with the show. So that tells you we have an engaged audience.
Any
Yeah,
good
it's
ones?
awesome.
Any ones that stuck with you? Anyone?
Yeah, there were a couple of good ones. Yeah.
Excellent. I feel like my left eye is swollen. I might have some allergies. Do you see
All
any
right,
redness over here?
TLC.
What do you think about that? Coby, you're you keep changing your position every week. Do you know that? Like this week you got the door. The week before you had half the wall. The week before that you had the whole wall. Now you got a book. Now you got a bookshelf. You're in the pool, or I think that's you.
That is
going
me.
on with the pool there.
It's me with my daughter in the pool. Yeah.
This is amazing. You never a dull moment with you here as our co-host.
I'm shirtless on the show as well. That's me shirtless. So
Okay.
now, Erin,
I like it.
next
Yeah.
week.
Let's go.
Hey, Meatloaf, 2 out of 3 ain't bad. Any final hot takes, fierce debates?
I think I'm debated out.
Yeah. My last hot take for the week is, and I had this conversation with Owen Lee this week. We were talking about the fact that, and John Hedlund was in the conversation as well. We were talking about the fact that the 2 Harbor is now moving to a 3rd vote, and I can see a world in which UWM wins this thing, and I would not be surprised if that's where it landed. Just because Matt Ishbia has done a really good job of shaking the confidence of the shareholders in management and what they're actually offering in terms of this transaction. So I would not be surprised if, and I don't know exactly when that date is. I think it's actually on the day of our next show. So it is possible we come on the air next week with UWM having won 2 Harbors. We'll see.
It got moved to the 23rd, didn't it?
That could be. I don't know.
Yeah, I think it got moved to the 23rd. I'm realizing Coby is quite the name dropper.
Oh yeah, no, he loves to drop names.
He's
Just now, and that's why he's smiling so wide. You see that? He's he's literally gonna break his jaw. He's laughing so hard right now. He loves it. You just completely nailed the guy. This is new. This is like newfound stardom for Coby. Yeah, I mean, no surrender has done wonders for this guy.
It's open.
Everybody
open
wants
doors that were closed
now.
to me.
My understanding is even the great legend himself, Brian Hale, even befriended Coby in Maine. Is this true? I heard a rumor.
It is true. I had a really nice conversation. He invited me on his show, which was really kind of him. We'll see. Talks are underway.
Well, you haven't made it until you get on Brian Hale's show, and I've been on, by the way, so I've made it.
A girl can dream.
I just want to say this is our 5th. Is it 5th show? 5th, 4th, 5th?
I think so.
Yeah. You think so? What? I gave you 2 numbers.
I think it's our 5th.
6, 7.
Having a great time. We are here to stay. I'm really just, Erin, you are the straw that stirs the drink. You are the secret ingredient, and it's been just so great to get to know you. So looking forward to more of these shows.
Thank you. Same. I love you guys. You guys are freaking awesome.
Yeah, we're the brothers what'd you say? We're the brothers you didn't know you needed?
Correct.
Something like that?
Yes,
Right.
Exactly.
Our thanks to Nye Young in the background. Have a great rest of your week, folks. We'll see you again next Thursday on No Surrender. Till then.
No surrender on the show. We go toe to toe. What's fair? What fails? Who gets the